inflation. Has it gone away? Is it here to stay? What are its effects, and how does it lie to us? I found this great chart on stocksarah.pythonanywhere.com, entertaining name, and right at the top, there's an inflation chart going all the way back to 1960, and this is annual, year-over-year inflation. And you can see this upslope in the 70s, and then this plateau in the 80s and 90s, and then a lower plateau after the global financial crisis, and the raging inflation that we've had since, but it's nothing compared to the 70s. I remember the 70s a bit. I was young, I was going to work, and inflation made things tough. It really did. I could sense anxiety in my parents, and just having businesses. My father always had his own businesses, trying to keep ahead of things. Very, very difficult. Trying to keep your pay, what you're making, up with what everything is costing. So if we scroll down to the bottom here, this is great. It's a heat map, it's called, and you have each year, the month-by-month inflation rate over that month the previous year. So it's year-over-year inflation. And you can see that during the first half of the 60s, there's no 2% inflation in here. This was actually a great era, even though stuff was happening like November 22nd of 1963, John Kennedy was shot. And then we had Martin Luther King and Bobby Kennedy, and then Lyndon Johnson was president, and during his presidency, we really ramped up the Vietnam War, and that escalated more under Nixon. And all of that came back to haunt us, that currency creation of these waves. You can see it climbing from the 1%, 2s, 4, 5, 6. It's very quick sometimes. And then 73, let's go back to 71, because in August of 71 here at 4.6%, we went off of the Bretton Woods system, decoupled from gold, and that allowed us greater deficit spending and massive currency creation. And what you see here immediately is inflation goes down for a year. Here's 2.9% from 4.6 1 year later. But then it starts creeping up again. And Gerald Ford became president, I think, right there. And it was, going from it was August, so 10.9, he became president. 11.9, 12.1, 12.2, 12.3. Well, as you'll see in a moment, best thing to do when inflation gets high, come up with a slogan. 75. In fact, we'll just jump to that right now. So Ford's slogan was win. Whip inflation now. And they came out with these buttons. You could get them at the grocery store. Whip inflation now. They were everywhere. It was on banners and stuff. And because it was time to fight back against inflation and recession and everything else. I sort of liked Ford because he was president for less than 2.5 years, so he didn't do anything. The best presidents are the ones that don't have the time to change the rules on business, to change the rules on everybody, to change the amount of deficit spending, to get a whole bunch of bills passed and stuff. When that happens, it just, every 4 years, businesses have to adjust to some completely new environment that may be good or bad for them. You start a business thinking that, this is a great thing to do under this economic environment that I'm in. And then 4 years later, it's a completely different economic environment. And even George Harrison got in on the act. Here's Ford's win button over here. This must be a button that George gave to him or something. But let's get back to the chart of inflation. Then we went into this raging inflation, and Reagan became president, and then Paul Volcker came in and raised rates incredibly high. But here we are, 14.8% inflation. You may as well, you know that the CPI doesn't take into account the financial markets and real estate and a whole bunch of other things where currency that you create can go, but every dollar must go somewhere. And so something inflates, whether it's savings or whether it's retail prices or whether it's the stock markets or whatever. Something has to inflate when they create currency. And then Paul Volcker got this under control by raising rates really high. And then we go into the Greenspan era, and it's still coming down. And we do have some twos in here. But this 2% inflation target that the Fed has, how often have we actually been 2% or under? They're scared to death of when it goes way under, and it did dip. Here's minus 2.1 during the global financial crisis. So this is mid-2009. But look at how the inflation was accelerating into the global financial crisis, and then once it happened, 5.6, 5.4, 4.9, 3.7, 1.1, just a few months, and then 0.1. 0. It soars going into this party blow off top, and then comes back down. And then we saw this again. We had the pandemic here, 2020, and we went down during the lockdowns into almost no inflation whatsoever. And then as some of that currency started, we still had lockdowns in 2021. But not that much. They were really lifted late, I can't remember exactly when, late 2021 or early 2022. And you can just see this suddenly soar. And 8.3, 8.5%, 9.1. And now it's back down. But is it going to stay there? What are the effects and how can this lie to us? The effects are... Since August of 71, since we left the Bretton Woods system, which was the last vestiges of a fractional gold standard, but still, gold put some sort of constraints on deficit spending and currency creation. So from then until today, it takes $1 today, which only took 13 cents to buy the same amount, like $1 candy bar. I was trying to go, what costs $1? What is there that costs $1? Well, there's got to be some candy bars or something that costs just $1. But very few things cost $1 today. I couldn't even think of something. But that is an 83% loss in purchasing power just since 1971. When you take it all the way back to the inception of the Federal Reserve, it's greater than a 90. It's a 97% loss in purchasing power since the Federal Reserve was created, according to the CPI calculator. In fact, I'll do it right now. We'll go, let me see. I'll just go January 1913 because it does go back that far, and we'll see what it says. 3 cents. So 3 cents then could buy what $1 buys now. So here's food inflation around the world of statistics. And like Lebanon, Venezuela, these are crisis levels in all of these countries. And the United States is down here at 8.5. But where did that 8.5, they created currency. Somebody created currency somewhere, whether it was the banks or whether it was the Federal Reserve. Currency was created. It went into circulation and diluted the currency supply. So it robbed anybody that was actually holding currency. But if you didn't get a raise in the period of time that we've had this inflation, if you didn't get a raise during that time to match it, it also stole from you, even if you weren't holding on to currency. If you didn't have assets that respond to inflation, such as gold, that kept ahead of it, such as gold has, then you're falling behind, and that purchasing power was stolen from you and given to somebody else by the Federal Reserve, by their policy, by the banks. So Yellen says she has no plans to lengthen the maturity of U.S. Treasury issuance. Now this is old. This goes back to March of 2021. Why did I do that? I just wanted to see if these people actually have a clue to what they're doing. So here we are today, and we're at a yield that the Treasury has to pay 3.8% on 30-year bonds. And they've got to pay even more on these short-term ones. But to get the Fed rate up there, somebody has to, they raise these rates. Somebody has to buy those at a high rate. And a lot of times that is the Federal Reserve. And banks need those short-term bonds and such. But let's go back to March of 2021. And we can go this is week by week. So we're going week by week, and April and May and June, July. So it's down. It's down at below 2% here, and I'm talking about the 30-year Treasury. So you could finance the government for 30 years at less than 2%, and then it starts to take off, and then you're going to see that they start raising the short-term rates. So they're doing the rate increases, but now we're up at 3.5. Now we're up at 4%. So that's for the 30-year. So it's too late to buy those and have the U.S. paying a low percentage on its national debt for years to come. She actually said that. It's unbelievable how clueless all these people are. So anyway, there are the rates. Then Yellen blaming consumers for inflation. That's the government's latest tactic. This is also pretty old. It's from December of 2022. But I'll tell you what, this is really actually quite funny to watch. It's people wanting to buy stuff. That's those nasty consumers that are causing all of this inflation. It had nothing to do with the bank. M2 is mostly created by banks, but the Federal Reserve and the banks, and it's Federal Reserve policy, and the loan requirements that are set out, and so on, that causes the banks to do what they do. If the Federal Reserve relaxes loan requirements, there's more loans made, and this explodes. I didn't show currency in circulation or base currency. That's not as much of a factor here. Base currency is a factor when it comes to the stock market and bonds and financial assets. But you can see that this exploded by basically 40%. What I've done here is I've indexed this to the beginning of the pandemic. So this recession that started when Powell created all of this currency, they added 40% to the currency supply and then try to blame it on the consumers. It's comical. They are just so incredibly clueless. And then they're slamming rates up and really hurting some people and benefiting other people. And it's causing this enormous wealth transfer. It's stress on certain businesses that are it's ruining people's lives, puts businesses out of business. And when you're a small businessman that just saved up or borrowed from a relative to open up a business, and then the Fed changes policy and has your head spinning and you lose everything because of it. So what are the effects? This is M2. This is M2 adjusted for inflation, real M2. Now take a look at the deflationary collapse that we're having in M2 right now, measured in dollars. This is the collapse measured in inflation-adjusted dollars. And it's enormous compared to and so what I did, I indexed these. Here is the whole thing going back to the beginning, and I've indexed them at the beginning of the pandemic, and you can see that when inflation took off, M2, real M2, the purchasing power of all of those dollars starts to fall long before. It was like 9 months before anybody was talking about, well, M2 is collapsing. So you zoom in on this, and as you can see, real M2 actually started falling. The value of the digits that are in bank accounts, the IOUs that the banks create that are backed by more IOUs. That's a longer story. There'll be a video out on that shortly. But that peaked in December of 2021, and the nominal M2, the M2 that is the number of dollars that are out there, really didn't start falling until after August of 2022. So a huge delay here, and this is all stolen purchasing power. due to inflation. The difference between this and this was stolen, and it did go somewhere. That purchasing power comes at somebody's expense. If you didn't get a raise during this period of time to keep your purchasing power up to the level that it was earlier, then these excess dollars that they created stole some of your purchasing power and bestowed it upon somebody that may have stocks, their portfolio in stocks, and it's going up hugely. And so anyway, this is gross domestic product. And so this is year over year change, year over year growth or contraction in GDP. And you can see sort of an average a little above 5% back in the 50s, and in the 60s it's up at about 7%, and then it goes up to 10% in the late 70s, 10, 11. There's 14.7% GDP increase, and it sounds great. However, and then in the early 2000s, we were at 6%, and then at 4.5%, roughly 5%, 4.5% after the global financial crisis. And now we're up at 7% growth. And that sounds wonderful until you adjust it for inflation. And then it comes down, and you see this is actually just about like 2.5% average, or a little over 2. Even back in the 70s, when it was showing 10% growth, that was 6.5 in that area. And then you can see how negative this goes sometimes. And when you cut off all of the peaks and fill in the valleys, you can see that the average is probably somewhere around 4% there. And it was about 2% here. You've got 1.3 to 3.6. Yeah, it's about, the average here is about 2% after the global financial crisis. So we shrank from 4%, then 3%, then 2%. And today, instead of that 7% growth, we have 1.6 inflation adjusted. That is how we get robbed and how we get lied to. This is the difference between the two. And then we've got people seeking safe havens. Now, the financial crisis that we just had, the banking crisis, Silicon Valley and stuff, that started in late March. That was here. This had already started, this flight from cash in checking accounts to cash in money market funds. So this was going up, and it went up huge. We're talking about going from $1 trillion to 1.444, so $1.5 trillion. So that's a 50% increase. That is huge. And so where did it come from? Probably from here, except it doesn't show it. The Fed isn't reporting that yet. This is supposed to be quarterly data. It says that it was updated June 29th of 2022, so about a year ago, yet it's only reporting Q1 of 2022 when it was updated about a year ago. Why aren't they updating this anymore? And is this going to be marked discontinued like so many Federal Reserve data sets have lately once people are looking at them? Because this is probably where it's coming from. That's going down. So this is Q1 of 2022. If we go back to the money market funds and go back to Q1 of 2022, so it ends down here in this trough. So all of this rise, this 50% rise, and billions of dollars. So this is, it's $500 million almost that has gone into money market funds. Where did it come from? It probably came from this 1.3 trillion. So this has gone down hugely, most likely. Now, I want to show you the Federal Reserve bringing us in for a soft landing. So this is like Chairman Powell talking to all the other Fed governors and the banks and everything and giving them their instructions, and they bring us in for a soft landing here. And so they're navigating the course, and this is the soft landing. So, read this caption. I want to thank you for watching. Click like and subscribe, and we'll see you next time.